This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of last lecture, I left you with a little exercise to perform, and here it is. Here, example 2. We are, of course, dealing with one category of non-pool assets, by far the most likely examinable topic in the non-pool asset area, and that's where you have assets with private use by the proprietor, only seen, as we know, in an income tax question when dealing with an unincorporated trader. There is no private use issue when dealing with corporate tax, as again we'll make mention of course, when we come to our corporate tax studies. So what do we have here? Again, as we know, and of course as you have already dealt with here, we had to produce the capital allowances computation for the year ended 31st of December 21. We're doing that here for Jane, and we're told at the beginning of the accounting period she has the following tax written down values. A main pool, and then separated out from that main pool, not included either within a special rate pool, not with these CO2 emissions anyway, but it is separate because of this. It's used 30% for private purposes by Jane. Who is Jane? Jane is the proprietor. This therefore is a private use asset. So we have our two tax written down values to bring forward. We also know that in relation to our format for the capital allowances computation, we're always going to have, on the far right hand side of our page, the allowances column, recording those allowances that have been claimed this period, be they AIA, WDA or FYA. And over on the left hand side of the page, we would have another little working column in which we would list out any expenditure that initially qualified for AIA, and at the bottom of this particular computation, any expenditure that ranked for FYA there. We read through the question to see, of course, whether any other columns based on any other transactions during the accounting period will be required on the CA computation. So what have we got? Firstly there, on the 10th of May 21, was just a normal purchase of plant. So that therefore will be AIA. And of course, on such a measly sum of £6,600, I don't think we've got any problem with our £1 million AIA limit. Then in June 21, purchased a motor car. Right. What do we need to know about a car other than what it cost? Well, there, of course, the CO2 emissions of 40 grams per kilometre. So with CO2 emissions of 40 grams per kilometre, they do not exceed 50 grams. That means it's an 18% writing down allowance rather than 6%. And it would usually mean that this is headed for the main pool. But then we read to be used by an, and all is well. It's not to be used by the proprietor Jane, it's to be used by an employee. In which case, this is purely a transaction where we go to the main pool. It, as we've had and as we would have assumed to have been the case in all the previous examples where cars have been bought, they've not been bought for the use by the proprietor up until this particular section. It's just been for other people within other, again, employees of that business. So here, whether it's 80% for business purposes or any other figure, it doesn't matter. There is no restriction of this capital allowance. This, therefore, is a main pool item. Sold the motor car used privately by Jane. Right, there was the car, the tax written down value brought forward, and now it's been sold during the period. That means, of course, that a balancing adjustment will be required. But when, of course, we do that balancing adjustment, we're told it's used 30% for private purposes. So that means, of course, that it's 70% business use. And only 70% of any balancing adjustment, be it allowance or charge, will go into our allowances column. Finally, in this period, we purchased another car, 16,000, CO2 emissions of 80 grams per kilometre. But this one is used 30% for private purposes by Jane, the proprietor. So this means that we require another column on our capital allowance computation for this particular car here with this private use by the proprietor. Now, we know what the cost is. We know it's got a separate column. We know it's 80 grams per kilometre. That exceeds 50 grams. So it's only going to benefit from a 6% annual writing down allowance, which figure, given that there's 30% private use, means we're talking in terms of 70% business use again here. Okay. Now, you've already done this exercise, I trust, but again, as you read through a question, it can't just be in one eye, out the other. We've got to be looking at the information provided in the light of the requirements set, always the first thing to read the requirements there, and then thinking about what we read and the significance that it has in the context of that requirement. So looking now at our answers, we've got our routine AIA/FYA column. There's no FYA here, there's no zero CO2 emission new electric motor car purchased, but there is AIA. We inherited the main pool, we inherited the 70% business use car, but of course that is sold and replaced with car number 2, and then we need the allowances column. Bring forward the balances straight from the question, then of course the additions that do qualify for AIA. Just one item there, the plant, 6,600, and of course we get our 100% AIA, so there's nothing to go into the main pool, all of which is allowances available this period. Then our other additions of the period, i.e. motor cars here. We've got the motor cars with, the car with CO2 emissions of 40 grams per kilometre, one that is just routinely used by an employee, therefore that goes into the main pool and will rank for WDA this period in full, available at 18%. The 80 grams per kilometre car, however, that was a replacement car for Jane, and that has, again, 70% business use, so it has its own column. Any disposals made during the period, we have to, of course, look at what was sold, and the particular asset being sold was not out of the main pool, but was that original business/private use car. What do we sell it for? £9,400. Therefore, the balance is at this point on the main pool 31,800, following the sale of the private use car 4,200, and of course the purchase cost of the new private use car. Now we can proceed to compute our allowances. Now it doesn't matter what order you deal with them here. You're balancing allowance. Now, why do we know it's a balancing allowance? Because, of course, we have sold it for £9,400. That is significantly less than its tax written down value. So we've not been able to claim, so far, from the point we bought to the point we sold, all of the allowances available to us. There's still a net cost that we've incurred here that hasn't been compensated for through the capital allowance system. That's £4,200, as we know from there. It's going to be a balancing allowance. That means we'll add it in to the other capital allowances of the period. But, of course, we won't add in 4,200, only 70% of that, which all being well comes to the 2,940. In relation to the new car, that we have £16,000. The writing down allowance is at 6%, given the CO2 emissions of the car. That 6%, all being well, is 960, limited, of course, to 70%, the business use component, which gives us the allowances there. But all of that 960, not 70% of that 960, must be deducted to derive there the amount of tax written down value to carry forward. The amount of private use component in terms of the non-pool asset, the asset with private use by the proprietor here, that amount of the expenditure originally occurred has gone from the capital allowances computation for good. It's never going to qualify for capital allowances. Not simply delayed, it's written off. You don't get that. So we only get 70% to claim, while 960 has been written out of our tax written down value. The other one, of course, was just the basic main pool exercise, the 18% on the content of that pool, add it in, and add down then to get the full capital allowances available for the period. All being well, job done and no problems. Back to the notes here, and what you'll see is that the next section deals with the other category of non-pool assets, something called short life assets, not simply an asset that has a short life, the term of which is defined within the note, as you'll see in a moment's time, but we make a depooling election in relation to that asset. We choose to take an asset that would otherwise gone to, as we'll see in the note, a particular pool, and say, no, I want to separate it out. Now, how we do that, why we do that, will come up in the next phase of the lecture. And for that, we're going to take you back to an earlier lecture because the rules have not changed. They are exactly the same. So it'll be an older recording, getting used to that by now, seeing the younger me. Those were the days. Which will take you through that and then lead on to the example, where are we there, example 3. Now, the only thing that will be different in the discussion of that answer is that those accounting periods, which for this example, in these study notes and the answer to which in the back of these study notes, is, as you see, for the years ended March 22 and 23, they are for earlier years. But all the transactions, all of the calculations you do are exactly the same, so don't worry about the fact that it's slightly different accounting periods. The technique, the principles shown are absolutely correct and relevant still today. Okay, so I'll hand you over therefore to my younger self yet again. Enjoy. Now, when it comes to non-pool assets, we've seen that there are two categories. We have now dealt with by far the most important category of non-pool asset, i.e. those assets with private use by the proprietor. Again, of which the most likely asset to have private use by the proprietor, a car. And that then gets you into the idea of the CO2 emissions, and therefore to know exactly what allowance would be available thereon as regards, is it a WDA of 18% or is it a WDA of 6% under the current percentage rules there. Now, when dealing with those assets, there was no choice as regards the taxation treatment. It was a non-pool asset. You must keep each and every such asset separate, and the reason why we did that was we would then limit any writing down allowance and potentially on disposal any balancing allowance. Obviously, it would equally apply in terms of a restriction of a balancing charge as well. So we had to keep it separate because we would limit the available allowances to purely the business use proportion. Now, what we see here is not a rule that says you must do this in relation to something called short life assets, but this is an election that is available to the taxpayer, to the business there. And obviously, we're only, as a taxpayer, going to make an election if it improves our tax position. So important to know, therefore, the sort of situation that you would be in which you would choose to make this election. A choice indeed these days that is incredibly unlikely, certainly so far as an unincorporated trader is concerned, and we'll explain that in a moment. First of all, just to say a little bit about it. Now, we said already it's an election, and we're choosing, it's a depooling election to omit a short life asset or assets from the main pool. This particular depooling election pertains only to assets that would otherwise have gone to that main pool. You remember, of course, there are specific categories of assets that go to special rate pool, and we also have motor cars, of course, where no AIA is available, only a WDA is available. Now here, as we'll discover, any plant and machinery that would normally go to the main pool would be available, except cars. Short life. If any asset is going to have within your business a short life, it's probably going to be a car. But we don't get the ability to make a depooling election in relation to cars. That's the one exception. Any other assets that would otherwise go to the main pool, you may choose indeed to make such a short life asset election. and can be treated therefore as a short life asset. So you're leaving them out of the pool. You're choosing to separate it out. You're making more work for yourself here in relation to the capital allowances computation. There must be a reason, therefore, to include any such asset in its own individual column and make this depooling election. Now, the idea behind it, if it's going to be valuable to the taxpayer to do this, is it would allow the acceleration of capital allowances on short life plant and machinery where they are sold at a low residual value. And we mentioned, of course, what do we mean by short life? Well, there we go. If it was scrapped within 8 years following the end of the accounting period in which it was acquired. Indeed, as we'll see, what we'll get is an asset that is sold within that 8-year period. That is the term we mean by short life. It's not that short, is it? Capital allowances on each short life asset are calculated separately, and the idea behind it, what we're looking at is an asset that would have gone into the main pool. So most plant and machinery that would otherwise go to the main pool won't actually end up in the pool, because when we buy it, what do we get to claim? We get to claim AIA. And what is the AIA limit now available to us? £1 million. It is therefore incredibly unlikely that any unincorporated trader, at least, is going to have such main pool expenditure in a 12-month accounting period that exceeds £1 million. What it will mean, therefore, is if you get your AIA, you've had 100% relief. The whole cost immediately relieved against the trading profits of that period. That's as good as it's going to get. This election is only going to come into play if you have expenditure incurred for an accounting period, main pool expenditure, that is in excess of the AIA limit. And in those circumstances, it may be seen to reserve the AIA for the other main pool expenditure, and any expenditure that was incurred on short life assets, those with a life of less than 8 years, we would think, and also, importantly, those that we anticipate will have a low residual value. Then let the other assets take the AIA, and then, rather than this residue of expenditure where short life assets exist that hasn't ranked for the 100% AIA, make the depooling election. Now, initially, when the depooling election is made, and while you continue to own the asset within the depooling election column, the short life asset, there's no difference. You will get a writing down allowance. Rather than it being a part of the pool and getting your 18% WDA, you've separated it out and you give it specifically the 18% WDA. Like within a pool, you get a tax written down value to carry forward, and on a reducing balance basis, 18% per annum on that reducing balance basis. So again, all it seems to be doing is to make more work for yourself. The reason why we do it is, as we've said, it's going to have a short life, and it's likely to have a low residual value. And it is equally one that is not ranked for AIA when we bought it. The expenditure that we've incurred has gone above the AIA limit of $1 million, most unlikely we've suggested, and therefore we've given the AIA to the other expenditure and chosen then to make the short life asset depooling election in relation to this short life asset. And the reason why: when a non-pool asset is sold, what do? We bring forward the tax written down value. We are anticipating now a high tax written down value because we'll have a year, 2, maybe 3 years. It's usually not a very long life where we make this election. We'll have a relatively high tax written down value and a low residual value. So when you deduct your low sale proceeds from the much higher tax written down value, what is going to arise given that it is non-pool. As you've just seen in the previous example, a balancing adjustment. What type of balancing adjustment? Sales proceeds much lower than the higher tax written down value. That's a balancing allowance. And what it means is that we are now able, when that short life asset is sold, to pick up all of the remaining capital allowance that would be available on that asset, so as to fully compensate us at that point of sale for the net cost of the ownership of that asset to that point of sale. Now you might say, well, okay, but how is that different to putting it in the pool? It's very different. If we had immersed, dare I say, that asset within the pool, and we'd been claiming a writing down allowance of 18% on the whole pool balance, that asset included, then when that asset was sold within the pool, it's got a high tax written down value, now it's sold low proceeds. What would happen? You take away your proceeds from your pool and you don't get a balancing adjustment. You simply get another 18% writing down allowance. And what would happen is that the residue of that expenditure would remain unrelieved within the pool for you to pick away at year after year after year, 18% per annum on a reducing balance basis. This system, by making this election, allows you to collect all of your available allowances within the lifetime of ownership. At that point of sale, you'll be fully compensated for then the net cost that you have incurred. Again, however, as we've said, and I'll go to the last point, or one of the last points here, is that given the amount of AIA available at £1 million per annum, it is very unlikely that the election would now be worthwhile. It's unlikely that the election would be worthwhile for most unincorporated traders. Why? Because if you've had AIA, you've had all of your tax relief. There's nothing else to give. All that would happen in those circumstances is you generate for the sales proceeds when sold. If you had separated it out, you would have a balancing charge. Nobody's going to do that. So it's only in these circumstances that you would be considering making the depuoling election for the short life asset. The total expenditure for, let's say, a 12-month accounting period that would be eligible for the main pool is in excess of £1 million. And within that total, there are one or more short life assets that you believe that you have acquired. And not just that they will have a short life, but as we keep saying, they'll have a low residual value. In that situation, allocate your million AIA to the other assets there and separate out the short life asset or assets. You'll only have one to deal with here, and make the depuoling election. Put it into its own column. As we said, while you continue to own, whether in the pool or separate, it's the same writing down allowance. But when you sell that asset, there is a specific balancing adjustment, which we anticipate to be a balancing allowance. That is the prize. We get the balancing allowance at the point of sale. Okay, back to the notes before we then do an example. On disposal within 8 years of the end of the accounting period in which the acquisition took place, a balancing allowance or charge arises. Now, we are going to have a balancing adjustment, but we'd only be making this election if we knew that not only short life, but also low residual value. A typical example, therefore, here would be something like computers, where again, they are probably going to be 3, 4, maybe 5 years, but 3 or 4 years shelf life. And again, they're then much slower than the current ones available. You need the most up-to-date in the business. And what's going to happen in terms of that now 3, 4, 5-year-old computer? Nobody's going to want it. You might give it away to charity or something like that, but very little, if any, residual value. So a typical example there. Again, though, we'll be only making this election if in the accounting period when bought, the expenditure levels had gone over what was the AIA limit. Currently very unlikely, as we say, because it's £1 million. Clearly, as we said, the election would only be worthwhile if a balancing allowance was anticipated. Now, I don't think it's going to be an issue for you, but we made the depooling election. Transpires, we don't actually sell. We keep. So if no disposal were to take place within 8 years of the end of the accounting period in which the acquisition took place, the unrelieved balance would be transferred back to the pool. Again, not an issue I think we need to worry about. We know, as we said, that it's main pool expenditure and upon which AIA would be available. If expenditure is outside this limit, then the expenditure on the main pool items will qualify for a writing down allowance of 18%. The AIA could be matched with short life assets. However, if total expenditure on plant and machinery is above 1 million, as we have just been saying, the AIA would be allocated to the main pool additions first, as no balancing allowance occurs on sale. If the AIA is allocated to main pool items first, then a short life asset election could be made on any short life assets, again with balancing allowances crystallising on disposal. So, only to repeat for the last time, sorry to keep repeating, but just so you can get your head around this, we're only going to consider making the claim where expenditure is in excess of the AIA limit, and we have within that total expenditure that would rank for AIA and B main pool, we have what we recognise to be a short life asset and one with a low residual value. That is the one to be separated out and kept in its own short life asset column. Now, this issue. An exam question may still be set, of course, for an unincorporated trader selling a short life asset where the election has been made. We haven't always had £1 million as the AIA limit. Immediately before this, it was £200,000. It has been as low as £25,000 in years gone by. So it may have been and would have been far more prevalent in years gone by. So what may happen, therefore, is you may pick up at the beginning of the accounting period what is an opening tax written down value brought forward of a short life asset. Now, what is going to happen, therefore, in relation to that asset this period? It's going to be sold, and most likely, as we'd expect, sold for a much lower figure of sale proceeds. So you're not making the decision in your exam question, do we, don't we make that election? That decision had already been made in years gone by, maybe sensibly then, because there was insufficient AIA to cover all the expenditure incurred in that particular period. And what we're now doing is to see that within the up to 8 years within that period following that purchase, we inherit at the start of this accounting period its individual tax written down value brought forward on this short life asset. Now it is sold. As any non-pool asset, tax written down value brought forward, less those proceeds, and you get a balancing adjustment. The probability, the only sensible outcome would be that the proceeds are much lower than the tax written down value, and therefore a balancing allowance arises. That's why we made the election in the first place. Now, again, if we're looking at expenditure now, it's hard to think that we're going to get expenditure in excess of £1 million. But given that the same rule here for short life assets applies for companies, in companies, of course, capital expenditure on plant and machinery in a 12-month accounting period in the bigger companies may very well exceed £1 million, in which case, therefore, it is still a distinct possibility that in a corporate tax problem you might have to deal with, as in practice, the short life asset election. And that's what we're going to see now in example 3, where we've got to calculate the capital allowances for the years ended 31st of March 20 and 31st of March 2021. What we're going to see is both the purchase of and then subsequent disposal of a short life asset. John, our hero here, prepares accounts to the 31st of March in each year. At the 1st of April 19, the beginning of the year ended 31st of March 20, the written down value of the main pool was a mere 16,000. Is that 16? Can't even see that there. Oh, wrong. Let's have a look. Yeah, a mere £16,000. On the 1st of July 19, John purchased machinery for, it's an unlikely proposition, isn't it? £1,020,000. I've got to go above 1 million to get this short life asset election being worthwhile. On the 1st of September 19, John purchased a photocopier for £40,000 and made a short life asset election. We're going to see why, because in the next accounting period, to be precise, the date of sale, the 1st of July 2020, the photocopier was sold for £15,000. So what we've done, we've made, as shown here, the short life asset election. We've reserved the £1 million AIA limit to be used firstly against the machinery there at 1,020,000. Obviously, we'll get a million out of the 1,020,000. The other 20,000 will go into your main pool. And the £40,000, the photocopier, doesn't go anywhere near the pool. It has its own separate short life asset column. In it goes for 40,000. There's no AIA available upon it, and therefore we get WDA. That will be what happens within the year ended 31st of March 2020. We'll go on to the year ended 31st of March 2021, where it will be sold for a mere £15,000, which will be much lower than its then tax written down value. That would be the original cost of 40,000 less just one accounting period's 1 year's worth of 18% writing down allowance. What will that give rise to? It'll give rise to a balancing allowance. Hence the point of the exercise. You've now managed at that point of sale to get all of the remaining allowances due to you to compensate you for the net cost of ownership of that asset. Let's have a little look therefore at how that manifests itself in terms of an answer. Now again, as ever, if you want to have a go at this, absolutely fine. In fact, I would encourage you to do so. See if you can do it for yourself. You'll be a lot stronger for that. If not, then let me take you through now the answer to that and see how we get it. Okay. Example 3. Again, 2 accounting periods to deal with, March 20 and March 21. What are we told? Main pool, 16,000, is your tax written down value brought forward. As ever, a value column in which to record the purchases, and because they're so big here, that's in thousands of pounds here as we'll record it. We know that we've got a short life asset, the photocopier, that is going to be kept separate to the pool. We make the depooling election. So we set up its column. And we know we need to record all of the allowances for the period. Tax written down value brought forward, additions then qualifying for AIA. The machinery at 1,020,000, the photocopier at 40,000. We make the depooling election for the photocopier, so it is going to be separated out there. The maximum AIA of £1 million would be allocated to the machinery. That 40,000 is going nowhere near the main pool. Oops, apologies for that. I'm the one who forgot to put his phone on silent. You wouldn't want to be next to me in the cinema, would you? So my apologies there. Right, now that the rude interruption has disappeared, let us continue with the answer to this particular example. I think when we were rudely interrupted, we had determined that because the total main pool expenditure incurred this period was in excess of 1 million, the AIA would be limited to that 1 million, and that on a £1,060,000 total expenditure would mean that £60,000 would only then rank for writing down allowance. So what have we done? We've immediately taken 40,000 of that expenditure and made the depooling election, treating it as this short life asset. That's left only 1,020,000, therefore going into the AIA calculation, of which we restrict to the maximum 1 million. That puts £20,000 of the machinery cost into the main pool. The 40,000 in the short life asset column. The £1 million, of course, the capital allowance, the AIA available. Right. Anything, of course, that was tax written down value brought forward, or expenditure that was not qualifying for AIA because we were above the AIA limit, goes into the pool. We've got 36,000, and of course on the main pool we can have 18% allowance. What we've then got is our short life asset, again the WDA, because it would otherwise have been main pool, 18%, and we take our 18% on that, and again those allowances will then be added in to the allowances for the accounting period as a whole, and get your tax written down values to carry forward. And when we go into the next period, we don't have to wait long, of course, for this short life asset to live up to its name and to be sold, because in that next period, bring forward our tax written down values, no further additions, but we do have the disposal of the photocopier for sale proceeds of 15,000. Leaving a residue of unrelieved expenditure in relation to what did it originally cost and what have we then sold it for, a residue of unrelieved expenditure of £17,800 there. Therefore, we are now able to claim all of that £17,800 in the form of a balancing allowance. When that non-pool asset is sold, we clear out any balancing adjustment. Again, remember, the whole point about this exercise, you'd only make this election if you knew it was going to have a low residual value as well as the short life. We've still got, of course, what was within the main pool, and as ever, that's 18%. That hopefully the calculation to be done. Put the two figures in, get your allowances, and that will be the allowances for the period. Okay, have a look through that, have a think about the things that we have said. Do bear in mind that although some of the issues here on short life assets can be problematic, the issue of non-pool assets, by far the most important one, and very, very likely to be tested in any Tax UK exam, is where you're dealing with assets with private use by the proprietor. Make certain that you focus on those. Don't get too worried about the short life assets. If you see it at all, probably all that will happen is you don't have to make the decision about a short life asset. The election has already been made, and you inherit at the beginning of the accounting period for which you have to prepare the capital allowance computation, a tax written down value brought forward. And what happens is it is then sold. The likely sales proceeds significantly lower than the tax written down value. But whatever they are, you can pair those proceeds with the tax written down value, and a balancing adjustment arises. Again, by far the most likely a balancing allowance. And that's it. In a corporate tax question, it is possible, given that the companies may be spending a lot more than an unincorporated trader may spend, that you may have expenditure, like here, that goes over the 1 million. If so, and they've got to tell you the life of this asset, it's going to be short, they may even say that you intend to make the depooling election in relation to the short life asset. What do? You get your AIA to your maximum on the other main pool expenditure. This asset or assets goes into a separate then non-pool column for that short life asset, and you take your writing down allowance there on, carry forward the tax written down value. Those are the outcomes you're going to see. Okay, as ever, go back through, review all that we've done during this particular session before then coming back to us, and hopefully we'll be able to finish off our capital allowances in the next lecture. See how it goes. Look forward to seeing you then.